Scott. So we are really fortunate to have with us today the leading economist who focuses on the real estate industry, who just happens to be our dean and the Larry and Clara Silverstein Chair of Real Estate at NYU. Sam's bio is well known to all of us, but just to highlight a few things that will be relevant. He is an advisor to the Federal Reserve System and to the FDIC on real estate economics. He's the economist laureate of the Real Estate Lenders Association, and of course the founder of Chandan Economics, an economic advisory and data science firm that serves the real estate industry. He got his PhD at Wharton, where we were fortunate enough to find him and bring him to Schack. And he's a regular contributor to the Wall Street Journal, Forbes, Financial Times, and so on. So Sam, if we could dive right in, we've talked to a number of other guests about the economic outlook, and the discussion has mostly been limited to, is it a V, is it a U, is it a W? As an economist, what's your sense of the outlook, and focus on the broader economy first, and then maybe bring it into REITs and real estate?
Thanks, Robin. And first, thank you for the very generous introduction. I will try to live up to that, and also to Adam and Scott for making this series possible, and Monmouth as well. To your point about the broader economy, I think what's critical for folks to keep in mind here is that whereas economists often work in isolation and are relying heavily on data sources in econometric models to make projections about the short and medium and long-term forecasts, one of the critical differences right now is that no model can be developed or will have any real credibility in its projections unless it involves consultation with medical experts and epidemiologists. And so what is really different here right now, and when we're thinking about economic forecasts and projections, when we're thinking about real estate market and sector forecasts and projections, is that if that analysis is not being done in consultation with and it does not involve engagement with medical experts that can help to inform our thinking about the trajectory of the virus and the range of possibilities for what that trajectory might look like, the folks developing those projections are simply missing the point of what's been going on in the economy and the larger world over the course of 2020. So the first thing I'd say is that our analysis is deeply informed by that discussion. And what's very clear is that, as compared to mid-March, as compared to mid-summer, we have a more nuanced understanding of the trajectory of the virus and the ways in which it spreads, the way in which it impacts different segments of the population today than we did just a couple of months ago. In the same way that a few months from now, we'll have an even deeper understanding on absolutely critical questions, such as, how will the coincidence of the flu season and the presence of COVID-19 ultimately impact vulnerable populations? And will we see mortality rates potentially rise in segments of the population that hitherto have shown that they can certainly be infected, but that exhibit a significantly lower rate of either complications or mortality? So when we're talking to epidemiologists, what we see is that there are a wide range of projections. We do have to talk to a lot of people and sort through the best possible data that we can get our hands on. And again, we're talking about a data set that is changing every day, that in many cases only a few months old, that exhibits significant variation in data quality depending on the source, the country it's coming from, the health authority that's providing the information. So that complicates the analysis. Invariably, the degree of political division in the country also complicates the analysis, because so much of our individual thinking and so much of our individual bias, and no matter how objective any one of us wants to be, we're all subject to some degree of bias. That's informing our thinking about some of this data. So we have to really make the extra effort to step back from the public discourse, the political discourse, to evaluate what the data is telling us. And what we see there is that in our, let's say, baseline scenario, the period over which the economy will return to previous levels of output is relatively brisk in the sense that as compared to the labor market, you could anticipate a scenario where by the end of 2021, output levels have returned to where they were pre-pandemic. What's important to keep in mind there, though, and this gets to sort of the next big question is, will that improvement in aggregate economic output in this baseline scenario, which is neither the best case nor the worst case, will it carry everyone forward? And what we know from the way that the labor market works in a modern technology-enhanced economy is that the labor market is going to lag significantly what's happening with aggregate output. Our ability to grow aggregate output also doesn't necessarily mean that every segment of the economy will improve in lockstep. It's a big part of our real estate discussion, whether we own retail assets or hospitality or office or multifamily, is also about which segments of the economy, what types of consumer and business activity will recover more slowly or more quickly. So there will certainly be some segments of the economy that will lag others. The most significant thing for us when we're looking at this from a macro and a policy perspective is that the labor market is expected to lag significantly the performance of, again, that more abstract measure of aggregate output that has little bearing on the reality of recovery for the median American family. And there, when we look at projections from across the political spectrum, when we look at the Wall Street Journal poll of forecasts, where you've got a very large number of economists that think about the world sometimes in very different ways, whether it's they're wearing their economics hat or their voting hat, but also projections from the Congressional Budget Office and from others. I think many anticipate that in that baseline scenario, we are in a situation where it will take 5 to 10 years for the labor market to return to levels of unemployment that were consistent with what we observed before the pandemic. And that's a very, very high bar because that was a historically low level of unemployment. But for us to return to a level of employment and labor market health that looks like something relatively manageable, that's within the capacity of our social safety net to sustain, I think we are looking at a recovery that takes several years. There are 3 critical levels of assumptions in the economic models right now. The first is what happens with the virus. And we again know that it can take different directions and turns in different countries. What we know from the United States and our experience over the summer is that it's also not going to be a linear move from that point of crisis earlier this year to one that feels like normalcy. We'll take a couple of steps forward in relaxing some of our guidelines and some of the restrictions we place on ourselves. And we're going to find in some cases that we've gone too far or that we need to adjust course a little bit. But we're in a very new world in terms of combating the virus, and we're learning as we go. And so there are invariably going to be some course corrections. And what I'd suggest here is that in our baseline scenario, we're making assumptions that have embedded within them things like a vaccine early in 2021, a vaccine that is partially effective. It's not a vaccine that will last you for life and that will prove efficacious for 100% of the population. At the other extreme, we're not assuming that it's as weakly effective as the flu vaccine, where you need to get it every year and it'll protect you against a certain set of strains, it will its longevity will be on the order of a few months. Hopefully, it'll be sort of a more efficacious vaccine than that. We also have to make assumptions about what percentage of the population actually gets it, the vaccine. And what we see is, there was a data set that became, or survey data that became available yesterday that was very clear in indicating that people sense that there may be some degree of political influence being exerted on the way in which we're moving to approve vaccines and going through stage 3 trials. And again, I realize there are folks from all across the spectrum that are tuning in for this. Whether it is real or perceived, there are differences of opinion out there about whether we might be pushing the approval process too quickly. And what's showing up in the survey data, I think the numbers that we saw yesterday 67% of the population has said that, or of the survey sample said, I'm not going to get the vaccine when it's first released. I'm going to wait to see how it goes. And sort of what happens with that first crew of folks that steps up and gets the vaccine. What we also see in the data is that roughly, in that survey data, roughly 30% of respondents say they're never going to get it. And so, one of the assumptions we've got to make is, well, where do we fall in the middle of that? We've got a vaccine that's partially effective, and we've got one that not everyone is going to get. What that means for us critically, when we think about the way that we engage in the economy as social beings, is that some element of social distancing, continues as a fact of life for the foreseeable future. That is part of our baseline scenario. The next level of model assumptions that we're making, and I see a question came in about what data set I'm referencing. What I can commit to folks is that on my Twitter feed, I will post after the call links to some of the research and analysis that we've done, some of the data that we're looking at, and my Twitter's just Sam Chandan. The other thing, so that the next level, so there are three critical elements of the modeling that differentiate from a standard economic model right now. The second one, after the virus, is what is the federal response? And so, what kind of interventions might we see? What kind of policies might we see? And it's everything from, the soft guidance on should you wear a mask, and how that influences, human behavior in the country, to the potential for another round of stimulus. So there's a bill. So there's a negotiation today. The Republicans are in the Senate are bringing forth a skinny stimulus. Their sort of term for it, not mine. But it's significantly scaled back as compared to even what was being discussed early in August. So roughly $300 billion. There's a lot of great stuff in there. I think the Democrats will argue that of the stuff that's great, fantastic, but there should be also more of the great stuff. Probably the thing that we feel is missing, that is absolutely critical to our economic analysis and our real estate analysis, is that skinny stimulus doesn't include any real support for cities and states. And when we look at the locus of and the center of gravity for fiscal crisis in the United States today and over the next couple of years, it is at the local and state level, where there is not the capacity to simply borrow. And so we look at a city like New York. How does variation in this federal response impact New York City? Its competitiveness in attracting businesses and retaining businesses and holding on to folks and maintaining a relatively sound and fair and competitive tax policy without any kind of federal aid. All of those things go out the window. Our ability to keep the subway system working in the way that we've become accustomed to as New Yorkers goes out the window. So, and to give you an idea of the order of magnitude of the challenge that we're facing in the United States today, in a city, and the degree of regional variation, by our analysis, New York City during the current fiscal year will record a deficit. This is New York City, will record a deficit twice the size of the deficit of the entire state of Texas. For us to internalize a $9 billion deficit, and this doesn't include the transportation system, and maintain basic city services, maintain even a basic level of education in the public school system, make the necessary investments in infrastructure, provide the social supports for folks that have been displaced or that are homeless, to provide sort of the healthcare support so that folks that may not have healthcare are able to get vaccinated in all of our interests, to keep tax rates at levels that are not driving some small but meaningful percentage of the tax base out of the city, really shifting sort of the balance of the tax cost versus the value of the agglomeration in New York City. The outlook without any kind of federal support is really, really tough. And that's going to lead to a significant degree of variation in city competitiveness as we think about where the jobs and where the real estate demand is going to go over the next couple of years. So the third level of the analysis is the local response. And that includes everything from how states and cities are going to manage fiscal stress, what kinds of investments they're going to make, the endowment that they're working with. What was the condition of their systems and their infrastructure going in? And this is something that really hurts New York, because deferred maintenance and investment, there were desperate needs when we had funds available. And now we're in a much tougher situation. But also at the local level, what kinds of responses do we see in terms of restrictions on mobility that are either imposed by state or local governments and limit our ability to engage as consumers and economic agents? But on the other side of this, we also see differences across the country and across the world in terms of consumers' readiness to engage, apart from any of the restrictions that are put in place by government.
Sam, you talked a little bit at the beginning about the recovery in output versus the recovery in employment. And I mean, I'm just curious to know more about that in a sense. If you can recover output to the previous level without employment recovering, and obviously you have some kind of greater, labor factor of productivity or something at work there, how is that achieved? And why do we then add the jobs back that we didn't actually need to get to the same level of output? I mean, which jobs are all the jobs that we do recover by the end of 21, if we're at the same level of output, those are all more productive, and then later on people hire back people who are very unproductive? Or what's the whole complexion of that? Because it's a paradox, it sounds like to me.
Right, so you could imagine a stylized economy with no technology. And in that economy, then you've only got one input to production, it's labor. So if you want to increase output, you want to make more things. The only way to make more things without technology is to have more people. And in that economy, what you're going to see is that output and labor move hand in hand. Once you introduce technology into the equation, and for all of us, it's hard to dispute that technology has played a greater role in generating economic output and, more importantly, economic value over the course of the last 100 years, the last 20 years. What we see is that our ability to create things that we can assign value to without actually having to bring more labor to bear, at least in the initial stages of the recovery. And we saw this after the dot-com boom and bust. We certainly saw this, but there's a lot of other things at play and a lot of other underlying drivers. When we look at the the great financial crisis, we have the capacity to grow the value of economic output without necessarily deploying more labor in the initial stages. Once we've got more money to spend, once more people are back to work, then the secondary effects of that, to support the service industry, can come into play. The concerns here are several. One is that in an environment of social distancing, even if it's 10, 15, 20%, this is a very small, anecdotal example, but one that, for a lot of Americans, has real implications for their livelihoods, and for all of us has implications for our experience of being social animals in this economy. If we have to reduce density in restaurants, let's say on a relatively permanent basis, whether we think of that as 2 years or 5 years, if we have to reduce density in restaurants by 20%, we have a lot of independent restaurants in this country that simply will not survive. The margins aren't there to operate at something significantly less than capacity. What that means for us then is that we have a significant segment of the leisure and hospitality workforce that is suddenly displaced and that doesn't have at its disposal immediately a set of skills that are easily transferable to the occupations where we actually observe growth. And so that becomes a real challenge for us. When we look at the labor market data today, and when you look at sort of last Friday's labor market report, we've seen that jobs are being created. A lot of that is folks being recalled from temporary layoffs, not net new jobs being created. When we look at the JOLTS data, job openings and labor turnover survey, and I can share that one on Twitter as well, it's not that we have a lot of net new jobs being created in the economy, but we do have a lot of people being recalled to work as demand improves. And that's, initially that number is going to be large as we're starting from such a low base of activity a couple of months ago. But in professions where folks depend upon physical co-location to actually be able to do their jobs, those are segments of the economy that are going to be really strained. When we look at something like hospitality, there was an improvement in occupancy for some segments of the hotel industry because you got leisure travel over the summer. There are very few businesses that are reinstating their plans for travel this fall. And so once the leisure travel falls away, which is obviously a lower margin business than the business travel, you're going to see some hotels experience another fall off in occupancy. in the Northeast and Midwest United States, as it starts to get colder outside, the restaurants have been able to bring people in because we've had this amazing sort of very Parisian experience of being able to sit outside in New York City as we've sort of, en masse taken over, our avenues and move the restaurants out into the street. Outdoor dining does not persist. And this, again, comes back to sort of, the combination of where are we with the vaccine? Where are we with the local and state government response? Will we be allowed to move dining back indoors at limited capacity? All of those things become critical to our thinking about this. One of the key takeaways, if you look at the Bureau of Labor Statistics report from last Friday, and I'd encourage certainly, young analysts, associates, students in real estate and business programs around the country, I'd encourage you to take a close look at this data and really dig in beyond the headlines. One of the things that you're going to see from the last report is that although folks that, although unemployment numbers certainly came down, significant disparities across race, across education, across gender get a lot of attention right now, as they should. And you could imagine sort of, if you're the primary caregiver, in your home, then you are in a very tough position, because if your young son or daughter's primary school is remote this fall, and you do not have the financial capacity to manage to manage some kind of supplementary care, your ability to go back to work or to go out there and look for a new job,
right,
is impaired and constrained. That has a real impact on labor market mobility, and there's a gender element to that. What I'd also suggest folks take a look at, though, because it's an indicator for us of some of the areas in which problems are going to arise, is that when we look at folks that have been out of work for longer than 15 weeks or longer than 20 weeks, this is what leads into long-term unemployment. That number did not go down; that number went up. And what we're going to see is, or this very pernicious dynamic take hold in the labor market, which is that the longer you've been out of work, the harder it is to get back in. And part of the reason for that is just signaling. Think about the behavioral and optical economics of this. If you've been out of work for 6 months, a potential employer is looking at your resume, seeing you've been out of work for 6 months, and they're making inferences about your value as an economic agent simply from the fact that you've been out of work for so long. And so whether it's a reflection of your actual quality and value and productive capacity, the fact that you've been out of work a long time actually makes it harder for you to get rehired. And so we have the potential to face a much more serious long-term and chronic unemployment or structural unemployment issue in the United States than we have in the past. And we have very limited means at the state and local level to actually support folks who find themselves in those positions. Our best hope there is to introduce an even greater degree of flexibility into the education system, particularly community colleges, to say, what are the skills that are in demand? How can we adapt quickly to actually make sure that folks who need to acquire new skills have the opportunity to do so? Give them the opportunity to re-engage in an economy that's changing more rapidly than ever before. Sorry, Adam.
No, it's fascinating. Robin is still frozen somewhere. Oh.
No, can you hear me?
Not well enough.
No, we lost them altogether. I have some cryptic notes that Robin left me. He seemed to have a vision that he might be disconnected today. Can we talk maybe, if you could, for a sec, Sam, about that we've talked about the sort of the real economy. But let's talk about the Fed, monetary policy. What's your thinking on where things stand in terms of Fed policy and inflation, which has always been such a key factor, of course, in the real estate world over the next year and two?
And it's been in the news the last couple of weeks. The Fed has been in the process of evaluating its long-term policy statement. We've got some updates on that from the last couple of weeks. What's clear is that neither the Fed nor any mainstream economist really sees in that baseline forecast. Remember, I think we're having to look at a range of possible alternatives for what the future might hold. But what the Fed clearly sees is a limited potential for significant inflation in the current economic structure. And that's not just over the next 6 months. That's something that I think we see as being the norm for the foreseeable future. And the best anecdotal evidence we have for that is just what's happened over the last cycle. orthodox traditional economics would tell us that in a historically low unemployment environment, extraordinarily low unemployment, in the quarters and years leading up to the pandemic. And thank goodness, that we had a strong labor market in that respect. What we would expect to see, what our traditional economic models would certainly tell us, is that in that environment, we would be experiencing stronger wage growth, and that would in part support a wage price spiral, particularly with low costs of capital. We should have had stronger inflationary pressures. So our rethinking about some of those basic economic models in a way that reflects, new and evolving, and changing economic structures, the neutral interest rate in the economy, the one that allows for the one that allows for us to grow at a sustainable path while maintaining price stability. That neutral interest rate is lower than what we would have thought of historically, which means that for real estate, we can anticipate, and the Fed's expectation based on the data that we have right now is that interest rates will remain low. We may not see them go up significantly from where they are now. Here's what's also critical, though. The Fed will allow inflation to rise above that historical target number of 2% because they're doing a long-term averaging now. So we've had this period of very low inflation, so we can afford ourselves this period of inflation that is above 2%. But the other thing that's really critical here is our assessment of how effective and efficacious the Fed's tools are. And I think that while it's subtle, there's some concession on the part of the Fed that their tools are just not as effective as we need them to be. That's a very strong statement. Let me say that the Fed's tools are not completely effective in achieving our monetary policy goals in isolation. I'll qualify this a couple of different ways. But the way that shows up is that we were not able to get to our target inflation rate, right? It's not that 2% is an upper bound. 2% is the number we want, in that regime. And our inability to get there is because we're simply not able to generate that kind of sort of price pressure. So I think what folks can expect is interest rates will remain low, absent some significant and unexpected inflationary pressure. The preconditions for stronger inflation just aren't there right now. Sort of flooding the economy with money on its own isn't going to do it. The capacity utilization isn't high enough to support this. We don't have we can produce more than we're producing now without pushing up against our productive capacity. The other, except in some specific areas like single-family housing construction, where lumber is a constraint. Skilled labor for single-family home construction, for small multifamily is a constraint. Areas where we desperately need more real estate. So I think. But the other thing for folks to keep in mind in real estate, we're folks that generally we don't mind inflation. I think economists and the Fed's expectation is that we're not going to see significant upward pressure on prices for the foreseeable future.
So Sam, let me ask you this. If interest rates are going to stay super low, how does that play into the timing of a recovery for real estate and REITs versus the rest of the market?
So I think it means a couple of different things for us. The low interest rates are going to exert upward pressure on equity valuations and on asset prices generally. And the more liquid the asset, whether it's sort of a stock or whether it's a real estate asset that is appropriately institutional that a REIT would hold it. That is a bridge to liquidity that a relatively smaller asset that a REIT wouldn't buy does not have. So I think all of those assets benefit in terms of upward pressure on pricing from the low interest rate environment. And certainly one of the things that we saw during the last cycle, one of the things that Robin and I have chatted about is how we manage distress in this environment. With the deterioration in cash flow, heavily concentrated in some asset classes versus others. And I think one of the key things for us here, why did we never see that, or perhaps inappropriately used term tsunami of distress during the last cycle? And part of it was in 2009 and 10, when we were talking about that tsunami of CMBS loans that would mature and the troubles we were going to have, almost without fail, our economic models at that point were making assumptions about what interest rates would be in 2017, 18, and 19, or 2016, 17, and 18, I should say, that were significantly higher than the interest rates that we actually had, right? We were sort of assuming that, by 16, 17, 18, we will have reverted to some normalcy in the interest rate environment, and the loans from 06, 07 were going to be difficult to refinance given those higher interest rates and given the limited amortization of those loans. You compare that to sort of the experience that we actually had. Interest rates remained exceptionally low. And that facilitated our being able to refinance, manage distress, get into other structures, in pushing asset prices up, more limited sets of scenarios in which we need to inject more capital to facilitate the refinancing. And I think that'll be a factor in the market here as well. Given, the publicly traded REITs, correlation with, the broader market. I think sort of anything that's lifting equity markets is also, lifting market caps. And so, that is something that, supports the REIT sector as well. It doesn't necessarily make financing more readily available. And I think what we see, on the capital market side is that, spreads and whether it be on the equity or the debt side of the market have widened out across the board. The degree to which those premiums have widened really does depend significantly upon which property type we're talking about. There's some where looking at the data, as we do every day at the NYU REIT Center that Scott leads, looking at that data, you wouldn't know that we were in the midst of a crisis or that there was a recession or a pandemic. And there are other sectors where it looks like we're experiencing something that is far more severe than the Great Financial Crisis.
So, Sam, let's switch gears for a moment and talk about patterns of space use and how that's being affected by the pandemic and how you see it continuing to be affected. Which sectors, for example, do you see having changes in space use that are going to actually create value?
Yeah, so you broke up a little bit there at the end, but I got the gist of your question. And I think sort of, for Scott and myself and several others on the faculty, there are some really key areas of focus for us right now. One is, in our urban lab, the fiscal health of cities and city competitiveness and how some cities are going to avoid or take advantage of, bankruptcy proceedings, and which cities are most at risk that way. The other thing that we're looking closely at is exactly this question of having to reimagine space use. And I think broadly in the real estate market, there's nothing that's being more hotly debated than the way in which we use space. And there are many dimensions to this. One is, will remote work continue forever? I think it would be a mistake to think that we will all suddenly go remote. There is value in physical co-location. It enables a type of collaboration that doesn't happen when we're working remotely. Does that mean that we need to meet and gather every day? Absolutely not. And I think what we'll find is that while we're not going to go completely remote, and while we are not going to go back into the office every day in the way that we did pre-pandemic, there's some reasonable balance there where we say, we've actually shown, we've proved to ourselves, all of the skeptics out there, including myself, that we can be productive. We can get deals done when we're working remotely, when we had our backs up against the wall and had no choice but to get the deal done while working remotely. And there are some tasks and functions that it's going to make sense to do remotely. If I spend every Thursday working remotely on emails, that might be the best scenario in the world. But when do I come into the office? I think we're going to be much more judicious, and we're going to say, when does it make sense? When is there added value? When is the outcome enhanced by my actually coming into the office? And that's when we'll see people come in. So there'll be some balance in the middle there. Some folks have said, well, also, if we want a distance, we'll need more space, in the office. We might need more space. Basic economics, though, is going to tell us that if one of the factors of production sees a deterioration in its productivity, right, we use space less efficiently because we need more of it per person. We're not going to pay more for an input to the production process that is less efficient. That's just basic economics. So this idea that we might be able to sort of enhance NOI because people are going to take more space and pay just as much per square foot as they have historically just doesn't fit with sort of how any market works. But there are these basic questions about how we'll work, how we'll play, how we'll shop. Most folks, Hamid Moghadam, Sam Zell, others that have come on to the series, I think have emphasized that there are some things that the pandemic has motivated that are new. But more importantly, it's accelerated things that were already underway. Whether it is how we shop, whether it's how we work, whether it's how we think about engaging with one another, underlying changes in our behaviors have been accelerated out of necessity. And our ability to leverage technology much more efficiently for remote work, and if we had allowed it to happen organically, this is where we'd be much further into the future. But that has real implications for space. I think what it also means is if I'm going into the office 3 days a week instead of 5 and working remote too, while there's a whole other conversation around whether cities are dying, people are leaving, people are staying. I don't believe that cities are dying. We have not seen a mass exodus. It's a process that will play out over time. Some people clearly are leaving, and it's the ones who have relocated for most of their time are the ones that have the financial capacity to do so at one extreme, and at the other extreme, those who simply cannot afford to remain in the city. But that median resident of Manhattan or Brooklyn or Queens, has not said, Long Island City, I'm done. That's not happened en masse. This process will take a much longer time. That's where New York finding ways to remain competitive, becomes critical. But what I think we see here is that if I have a different balance, and I'm in the city 3 days a week, going to the office 3 days a week, whereas when I was going in 5, I had to sort of make a call on this and say, well, going in 5 days a week, I need to be pretty close to the office. I can't do that. I can't do an hour commute, each way 5 days a week. As the balance adjusts, the radius within which I can think about locating starts to expand. And you're going to have some folks who are saying, well, if I only am going in 3 days a week, I can tolerate that commute, an hour each way, 3 days. And in return, what I'm going to do is I'm actually, I've just had, my second kid. My first is 4 or 5 years old. I need to start prioritizing a good quality public school. It was a really, really tough situation and a tough optimization problem for me to work through. When I was, previously, but if I'm only going in 3 days a week, I've got a wider range of markets now that I can think about as relevant. And I think that's the way this process plays out, over the next couple of years as people's leases expire, as they get a sense of whether or not there will be any degree of permanence to their company's, remote working equation. All of that becomes important. Some of the hardest hit folks in all of this, of course, are the services that support office workers. So I can only imagine sort of, the pret-a-manger, the Chopped, all the places, at the base of, our academic building on Bryant Park in Midtown Manhattan, how they struggle without people in the office. That doesn't get as much attention, as sort of, what's happening with office leasing, but it's an important part of the equation as well. Areas where I think, where we see, improved demand, look at the intuition of the market. Another data set that we're looking at almost every day is year-to-date yields on investments in different REIT stocks. I'm not looking at it because I'm investing in different REIT stocks. I'm just a college professor. I'm looking at it because I want to see what is market sentiment with regard to different property sectors and property types. And because no matter what we think of in our economic models, understanding the market's thinking and the market's intuition is important for us. And what we see there is that the market clearly is discounting hospitality and retail in a way that has not seen significant improvements from a little while ago. And at the other extreme is fairly bullish on data centers and industrial. So I think that's where that's where things play out. Where I think there is a real opportunity. We built a lot of multifamily over the course of this cycle, no doubt, in response to sort of the stylized millennial. And it's a mistake to treat the millennial population as homogenous because it's not. But sort of this idea that every millennial is graduated from a good college or a graduate program, wants to live in a small urban apartment with access to lots of amenities and sort of lifestyle and community engagement. As the oldest millennials going into the last cycle, were in their late 20s, and they're now in their late 30s and early 40s. And I think what we see there is clear shifts in preferences that are being driven not by sort of any kind of fickleness in people's behavior, but changes in sort of where they are in the stages of their household's life cycle. And the need for more space because of child rearing, because of prioritization of, again, good quality public schools, coinciding with the potential for a shift in commuting patterns, is something that is putting upward pressure on demand for single family rentals in the United States, and small multifamily properties. And those are two areas where we've seen a paucity of new development over the course of this cycle, and where increasing construction costs, limits on the availability of skilled construction labor, have actually constrained us in bringing new supply online. It's one of the key areas where I see an opportunity for us to bring new supply online. And if there are ways in which we can address rapidly increasing construction costs, constraints on material and labor availability, perhaps through the deployment of more modular construction techniques, that's going to be an important area for growth.
So Sam, let's zero in, taking everything you've said, zero in on New York City. If economic output is back to where it was pre-pandemic by the end of 21, what does New York City look like at that point? Has everything gone back to normal, or is the lag in labor in the labor markets mean that it hasn't yet? What's it look like?
So I don't think it gets back, in that time frame to something that looks like pre-pandemic. And part of it is that there's been this has been a very destructive few months for the economy. We've seen a lot of independent businesses close, and those don't just come back overnight. And so when we reopen, there are some restaurants that simply don't exist anymore. There are some retail venues that don't exist anymore. So I think the landscape feels quite different going forward. And again, this is where the anecdotal, as I'm an econometrician, data is at the foundation of everything I'm doing. But I'd be a fool to not be engaging every day with folks in industry and in the market to understand what they're thinking and feeling, what plans they're making. And when we're talking on an anecdotal basis to different companies, members of Schack's board that own a significant share of the office buildings in Manhattan, what are your business resumption plans? What we see is that they actually sometimes look a little bit different from business resumption plans in other parts of the country. One of the factors here is concerns around congestion in the public transportation system. So we can argue, based on the medical data and the articles in JAMA and the changing and evolving evidence about how dangerous or not dangerous it is to be on the subway, the reality, I think, for a lot of people is that they experience some anxiety at the idea of getting onto a congested subway. And that is hampering sort of our access to buildings. And what I think landlords are finding is that I've got control over what happens in my building. I can check temperatures, I can stage people's entry and exit, I can put in very simple low-cost technology to measure the number of people in the building at any given time. I can say only 3 people in the elevator. Those are all things that are within the scope of our control. I can clean, I can put in the MERV filters, all of that. One thing that is outside the scope of my control, but is ultimately critical to my ability to resume business, is how people get to work in the first place. And given the degree of anxiety that folks experience, given the subways, given the how much traffic has fallen, are not congested today in the way that we would have experienced on an average 8 a.m. commute, going into the pandemic. But that lingering sense of congestion in our subway system is a source of anxiety for a lot of people, and it's impacting business resumption plans. It means that many companies are saying staggered start hours and end hours, or flexible schedules where folks aren't coming in every day. And we're very early in this. You can reasonably expect that things begin to change once we have a vaccine. What folks should not think, and I think sort of what, again, our consultations with medical experts and epidemiologists tells us, is that it would be naive to assume that if we get a vaccine, a couple of weeks or a couple of months later, everything is back to normal. Limitations on the efficacy of the vaccine, on the number of people who actually get it, are the major unknown right now of how people will fare when they get COVID, if they also if they're also infected by the flu. These are all major unknowns that mean that there's going to be a lag between when better treatments become available, a vaccine becomes available, and what work life looks like. So I think in one sense, there's permanent damage that it will take time to recover from in the form of closed businesses in New York City. The longer lingering impact of this and the more troublesome one for us is New York. I'm a big believer in the city. I will never give up on New York City. And I know the same is for every New Yorker. But that doesn't mean that we don't face a period of significant challenges and that we don't need to be really smart in rallying resources. Our margin for error coming out of this crisis is small, much smaller than many other cities. And part of the reason for that is that we are on the cusp of a fiscal crisis. If folks don't believe that, again, look at those numbers that I cited up front. The deficit that we will likely run in the current fiscal year in New York City is twice the size, just the city, twice the size of the deficit that the entire state of Texas will run. We do not have the capacity, absent significant external aid from a higher level of government, to maintain a basic level of services across the board and balance our budget right now. The way in which this is going to be most directly observable for New Yorkers is in our subway system. It changes the experience of being a New Yorker. If we cut subway service back by 50%, if subways are not running 24 hours. Now, there's a great economic case for not running them 24 hours, but it's a counter purposes to our addressing people's anxieties around congestion in the subway system if we are running them on a more limited set of hours with a much more limited set of trains. But right now, we're in a really tough spot to figure out what the alternatives are. There is going, what we would hope is that between folks walking, biking, using buses, staggering hours, working some element of remote into their schedule, that we come to some kind of sustainable equilibrium. But that's one that looks different from where we were. Not everything about this is bad. Quite frankly, I love outdoor dining, and I wish that it were that we were able to do it year round. That is a small silver lining, though, to what ultimately will be sort of an economy that looks and feels a little bit different. But that has implications for what space demand looks like as well.
Fascinating. So we're going to take the audience questions in a moment, Scott and Adam. But one last question, leaving New York for a moment and talking about the stock market, which you mentioned. You're a college professor. You're not speculating, but you are watching the data to try to make sense of it. What do you make of the fact that the REIT index has lagged the S&P 500 since March by a significant margin? What do you take from that, and what do you expect to see as we find solutions to the pandemic?
Yeah, you're absolutely right. And if folks want to see how that breaks down by sector, follow Schack or myself or Professor Robison on Twitter, because we share these kinds of analyses all of the time. But I think my takeaway when disaggregating it is that it's hard to draw conclusions about the causal drivers of the REIT index lagging the broader indices just from looking at the aggregation. The deeper story is in the disaggregation. And what we see there is that while even the best performing REIT sectors are not quite keeping up with the market, there are a couple of different things going on here. Most important is just what's driving the headline index. And the largest 5 or 6 tech stocks are what's behind this. If you remove those, then the performance of the broader cross-sector REIT index looks pretty damn good. We've got Apple, we've got Facebook, we've got Alphabet, that are driving a lot of this, and there's been a lot of volatility there. The last couple of days have been pretty painful for folks that are overweighted to the tech stocks. So when we get that next weekly update on our REIT numbers, we might not look so bad. But when we disaggregate the numbers and look across sectors, what I think we see is that there's a lot of concern around this larger question, and one that we won't. No one knows exactly what consumer and business behaviors will look like in 12 months. we're evaluating different scenarios and trying to make sure that we're mitigating the risks associated with those scenarios. That's just good risk management. Is first admitting that we don't know where we're going to be in 12 months, looking at what some of the downsides are, and then figuring out how to protect against those. But I think what we see here is that there's quite naturally, the market making some bets. What sectors does it like? What sectors doesn't it? As much as the market likes industrial, and as much as it likes data centers, it doesn't like those enough to offset how much it's nervous about retail and hospitality. And so what you see in the aggregations is that lag. But again, I don't want to understate how, in almost any asset class, if you're not tech, you're wondering why you're not keeping up with the S&P 500. Up until a couple of days ago, Apple hitting 2 trillion. It's the tech stocks, and this has been widely reported in The Economist, The Journal, Bloomberg. A relatively small number of stocks, at the top of the indices, accounting for a disproportionately large share of the overall index value and movements. One of the things that I do want to make sure I point out, because we haven't touched on it, when we do talk about sort of disparities, I'd like to bring it up in another context. When we're looking at the labor market data, when we're looking at the housing data, one of the things where people are going to find jobs that have been displaced, and one of the things that is absolutely critical for us to keep in mind is that whether it is the pandemic or whether it is the labor market, there have been extraordinarily disparate outcomes in terms of how all of these things have impacted different segments of the population. Relatively more income-constrained families living in multi-generational households, communities of color. And there's a range of different reasons for this that we could spend an entire semester discussing, have been impacted in ways that are deeply troubling. And policies that support folks being able to re-engage in the labor force, that address the potential for significant housing dislocation, are things that are not getting, in my view, enough attention in the policy dialogue, but that will require more attention over the course of the coming months, particularly if we do not see that skinny stimulus or something perhaps a little bit more robust than the skinny stimulus find its way to consumers and to impacted families over the next couple of weeks.
Great, thanks. We're almost out of time. Scott, I see there are a whole pile of audience questions. You want to throw one out?
Yeah, Sam, you alluded to work from home. I think the economy, as you said, is rapidly accelerating down vectors that were already in place. Retail dealt with it, referred to it as omni-channel. I think the rest of the economy is rapidly becoming omni-channel, whether it's education, work. And not coincidentally, our REIT symposium that had to be canceled this year was called REIT Opportunities in the Fourth Industrial Revolution. So there's going to be a lot of capital that needs to be invested into real estate to advance us into an omni-channel economy. Couple that with, and you mentioned this early on, the aging infrastructure we have in the U.S. We're seeing the impact on that in conjunction with climate change on the West Coast and California and the fires. There's a lot of capital that needs to be invested into both the traditional economy and the digital economy to move us forward. Set the capital need against the backdrop of low interest rates in perpetuity. Does this mean we are now all MMT at this point?
So I think your point about infrastructure investment and the need for it's critical. And I should have mentioned that when we do disaggregate those REIT numbers, infrastructure is also an area where I think the market sees both a need and an opportunity. The fact that capital is available at historically low costs and that we anticipate that it will remain so for some time, is a key facilitator of this. What I'd suggest is that the missing ingredient in addressing this is figuring out what role government will play. And perhaps the role is none. But if we have not seen, let me put this on a couple of different levels. At the local and state level, the financial capacity of government to actually facilitate infrastructure investment is extremely limited right now. What that does mean for us then is that there's a more significant role for the private sector. So how do we get infrastructure? The capital costs are low. We need the infrastructure. In the public sector, we don't have the capacity or the wherewithal. Then what is the role for the public sector here? It's to clear the path and put the regulation and create a regulatory environment in which the private sector can actually take the lead and say, we need infrastructure, we've got access to the capital, we're going to do it. All of the regulatory impediments that stand in the way of the private sector taking a leadership role in building infrastructure in the United States is exactly what we need to do.